So hey guys, it's me Yongik again. Sorry, let me just close this. Okay, so it's me Yongik again. Today I'm gonna do a video game analysis that's requested by the members of this group on Nintendo, and I thought it was a pretty good chance and pretty good opportunity for me to actually share the other gaming stocks in the sector also. Right, so without further ado, let's head on to it. So Nintendo is a gaming console company launched 1983. It started with portable Game Boy, then started switching to Wii, then Nintendo DS, then now the most famous one is the Switch. Cause sorry, I don't play games anymore, man. Ever since I started investing, I stopped playing games. So yeah, they have this thing called the Switch, and then the popular games like Super Mario, Pokemon, Zelda, and if I'm not wrong, there's a new one, what Yoshi something one lah. Yeah, it's quite, I don't know, man. So anyway, it's a company that operates in Japan. The price to earnings ratio is 26.78. The price to earnings to growth ratio is negative 3.96. Alright, so you can see down here that Nintendo is one of the largest companies out there in the gaming industry. But I would say, beside all these, there's Take-Two Interactive, there's Electronic Arts, and even Tencent is also inside. And also companies like Valve. Valve is not inside this kind of place because they're not listed on the US stock exchange or any other stock exchange. They are a private company. Okay, so let's quickly do the business analysis. So intangible assets, yes, Nintendo has. Network effect, yes. Monopoly scale, yes. Cost advantage, yes. Switching costs, I would say no, because they only have this many games, right? So for pricing power, honestly, games right now, they really don't have much pricing power, I would say. I mean, sometimes some people still do pre-order stuff lah, so okay, let's give it a benefit of the doubt. Let's be safer lah, so we just put no lah, okay? Let's be safer. On the safe side, so we put no. So micro analysis, presence of technological risk, yes, there's definitely is. Presence of inflation risk, there's definitely inflation risk. Political legal, there is no political legal, except for if you are trying to enter the China gaming industry, then there is, but I highly doubt that Nintendo is going to that industry. They're more trying to attack conquer the US or Europe and the Southeast Asia, but so less of China, I would say. Then we also have presence of specific people risk. Nope, I have no idea who runs anything in Nintendo, so yeah, no. So moving on to financial assessment, we can see that wow, it's actually performing decently. I would say 5 greens, 4 red. So well, it's decent, but there's a couple of red flags that we should be aware of. And we also notice that there's a dividend cut. Now this is very, very important because when a company cuts their dividend, means that something is wrong with their cash flow. That's why they have to cut their dividends, and it's a huge red flag in fact. Okay, so let's move on now to confidence rating. So actually we are not confident. The calculator actually shows that we're not confident in investing in Nintendo because it shows a rating of 3.75 upon 10. For growth entry price, it shows us 68 cents. Well, that means that the stock currently is super overvalued. If you're going for dividends, you can enter at $12.80, and if you're going for assets, you only get back 9 cents per share. Okay, so it's quite bad. Alright. Now let's look at momentum. Based on the momentum of all the charts, everything, we can see that it's currently a sell. It's 50% of the time it opened higher. Of past 3 years, right? 50% of the time it opened higher. 50% of the time it opened lower. Okay, stock actually went up higher, stock actually went up lower. Overall, it's still a downtrend, and the whole summary looks to sell. Now, when we take a look at the financial metrics, you can see almost everything is red in color. That is quite bad. I mean, all these are in JPY lah, but don't worry, I actually already changed here already for you guys. So yeah, it's quite bad to see everything in red color. So yeah. Now moving on to the growth tab, right? We can see that really, to be honest, it's trying to give the best value it's trying to give is just $15, and the best valuation we got is $15. And being conservative, we cannot choose that figure. That's why we in the end got a figure of 3.68. You can see down here, it's very obvious that over the past 10 years, Nintendo's EPS has been falling. So to be honest, I wouldn't recommend a buy. In fact, let's take a look at the charts. When we take a look at the charts, right, you can see down here, first of all, we can draw a very obvious trend line downwards. Okay, this is a downward sloping trend. Every time you hit this line, drop. Hit this line, drop. Hit this line, drop. Hit this line, drop. And then it's trying to challenge this point again. Now, secondly, we can actually draw a sideways trend line, whereby we just look at here, we just draw here. You see, every time we try to hit around this point, this mark here, it dropped again. So either drop back down or it rebounds back up. So this is actually a rather strong support slash resistance line. So now let's take a look at the earnings itself. So we can see that over the past few years, while there's a lot of red in color for earnings, Nintendo isn't really a company that's performing really well. So so with that said, they actually cut their full year forecast for next year, which is quite bad. I mean, if a company is cutting their outlook, means they're predicting a lower sales. And let's take a look at what they have currently. They have this Yoshi, that's why I said Yoshi Crafted World game. There's this Nintendo Switch. Hold on, let me just change this to another company first, which I want to share with you guys. The company is EA, but I'll get to it later, alright? So Nintendo Switch, Pokemon, I mean these are all hype games, they will pretty much die down very, very fast. Okay, let's compare with another company called Take-Two Interactive. Now, Take-Two Interactive is one of the more popular gaming company where we took a look at the past earnings history. You look at this, there are so much more green compared to Nintendo's. Oh no, I just closed Nintendo's. But okay, just now you can actually go back and watch the video again. Just rewind back a bit. You can see that it's so much more green in color. You just look at it, even if you don't understand the earnings report, you just look at the green versus the red, you can tell that Take-Two is a better company than Nintendo already. Then when we take a look at Take-Two, it says that their most popular games, largest contributor, net revenue grew means increased, $1.249 billion compared to $480 million last year, third quarter. Okay, so that's actually a 24% increase for total net revenue based on the games itself, and the games are Red Dead Redemption 2, NBA 2K19, NBA 2K18, Grand Theft Auto Online, WWE 20. I mean, all these games sounds like games that we would play. I mean, even if I don't play games right now, I still know of these games because these are very, very popular games. Okay. Now, this is Take-Two Interactive. Now, let's take a look at another company, which is Active Blizzard. Similarly, Active Blizzard is also another company. If I'm not wrong, last time we created World of Warcraft. Yeah, because I was playing that last time. So anyway, when you take a look at Active Blizzard, similarly, you see there's a lot of green compared to red. This is a very, very positive thing you want to see in a company. You want to see strong earnings, alright? So, recent quarters didn't really do so well. When we take a look at earnings report, we see that the CEO actually said this, that while financial results for 2018 were the best in our history, we didn't realize our full potential, right? So, even if they said that, they said they did not realize their full potential, but then somehow or rather, they are guiding revenue lower. Okay, so I'm not too sure what's going on. This company, the guidance and whatever the CEO say does not make sense. They tell you that they did not realize their full potential. So if they realize their full potential, technically their earnings and the revenue should go up higher. But then they guide down. So it's just very weird. Okay, so some games that Active Blizzard have is Diablo, Hearthstone, Heroes of Storm, Overwatch. All these games are also games. Candy Crush. All these games are games that we know of these games, right? Even if you don't play games, you confirm got hear of it. How can you not hear of Overwatch? How can you not hear of Candy Crush Saga? How can you not hear of Hearthstone and Diablo? Right? These are games that you confirm 100% will hear before. Now, next, let's move on to the last company, which I really want to share with you guys. Now, take a look at this company, right? It's EA. Okay, when you take a look at EA, let me just change this back. So EA is quite overvalued right now, 29.72, PEG is 1.49. And if you take a look at business analysis, there's nothing much to look at because almost everything the same now. Okay. Now we look at the financial. Wow, it's so much better than Nintendo itself. Now next, when we look at the ratings, we got 77.5 upon 10, which is rather positive. The growth entry price is $71.72 compared to current price of $99.26. That's why I say it's overvalued. They did not give out any dividends, and if Electronic Arts were to close down today, you get back $10.68 as a shareholder. Now, when we look at the momentum setup, it's a buy. Okay, let me show you why. So when we look at EA, so the reason why EA is showing a buy is because it is actually, you look at all the MACD, everything here. I mean, it's all showing rather positive. It's like going upwards already, and it's trying to break past here. It actually was able to actually sustain this 50 days moving average, and now it's trying to break above this 200 days moving average. I would see that they will actually break above it, but let me show you why first, okay? So the reason why is because of the fundamental reasons. First of all, let's take a look at their earnings also. Quite impressive, a lot of greens compared to red. They missed their earnings on 2018, the latest earnings on December. So what happened is that they actually slide 10.6% after a quarter 3 report, whereby it says that quarter 3 was a difficult quarter for Electronic Arts. They did not perform to their expectation, and we are now applying the strengths of the company to execute better earnings in the future. And then they actually guide down, right? If I'm not wrong, they actually guide down. It expects a revenue of $4.875 billion versus a forecast of $5.2 billion. Okay, this means they are guiding downwards. But it's really funny because after they actually announced, see, look at this. So earnings, right? What happened was earnings, they actually dropped 10% down, right? And after the next few days, rally all the way up. Why? Because they released this game called Apex Legend, right? Apex Legend. Apex Legends, right? This is the game Apex Legend, where it's a free-to-play battle royale game where everyone can just go in and play and be the last man standing, something like PUBG, alright? And then the most interesting part is within currently this article was written, I think, on 4th March, 11 days ago, right? 11 days ago. So they actually say that it actually hit, where is it? Tops 50 million users already. Now let's just say if one user, everyone just spend just $1. I mean, obviously no one will spend not everybody will spend money in a game, right? But let's average it out. If everyone spend just $1, right, per month, that's easily $50 million in revenue already. Okay, and then they tell you that they are guiding down. They are guiding down for the next year and next quarter. So I think this is a case of a under promise, and then subsequently they will over deliver, because I really feel that, you know, EA with the Apex Legend, with the hype, I mean, you go ask around what's the latest game, any gamer will tell you it's Apex Legend. Any gamer will tell you that they are playing Apex Legend. And as we all know, this thing called the network effect, the number of gamers increase, the value of the company increased substantially. Now, Take-Two and Active Blizzard are losing a lot of market share to EA because of this game. So, again, $50 million revenue per month, you times by 3, that's really $150 billion. And we're just talking about one game. They still have a lot of other games that they have not even factored inside it. This one game itself will potentially make them a lot of money. And that's just my own personal opinion, because that's why I was skeptical about this Apex Legend, because I'm not a gamer and all. That's why I went to ask my friends, and you know, what were they playing, and every single one of them are telling me Apex Legend. And that's why I also, you know, went to do some research. The number of players is increasing. You don't need to buy the game. All you have to do is just buy skins and buy all this in-game items and all, which, you know, if you are a hardcore gamer, you always buy them. Alright, so I've come to the end of this analysis on these 4 gaming companies: Nintendo, EA, Active Blizzard, and Take-Two Interactive. Now, I would say that the other 3 companies, Active Blizzard, Take-Two, and EA, I would say they are better companies, considering that they have actually beat more earnings compared to Nintendo. But I will stress again that all 3 of them are overvalued. Now, if you're looking to enter EA, you can enter at $77, which is around here. So let's just hope that, you know, it comes back down to this point, or what you can do is you can keep selling puts to keep lowering your cost all the way down to $77. Okay, so I've come to the end of this recording, and I will see you in the next recording on the next ticker symbol. Alright, okay, bye bye.